10. Stock market mistakes that keep investors poor. Imagine you have invested in the stock market for over 10 years and you are not making money. Meanwhile, there is someone else who started investing in the stock market around the same time you started, and they are making money. It isn't because they have inside information. It isn't because they are financial geniuses. It is basically because they avoided mistakes which you did not avoid. That is why today I reveal 10 stock market mistakes that keep investors poor. Mistakes that cost people thousands of shillings. If you avoid these mistakes, you'll already be ahead of most investors. Watch the whole video because you're gonna get amazing tips. At point number 10 is waiting for the perfect time. Most people spend years waiting. Instead of taking action, they wait. There's never nothing like perfect time. People have excuses. I'll wait till the end of elections. I'll invest next month. I'll wait till I have money. All these are excuses because perfect time never arrives. You take the step to invest and then you're going to realize the benefit. The biggest risk isn't investing too early. It's never investing at all. If you don't invest, you stand no chance in taking part in the stock market. The ninth mistake is chasing hot stocks. We've all seen it. A stock doubles in price. Social media starts talking about it. Everyone suddenly wants to buy that particular stock. Very unfortunate. That often leads to bad decisions which are costly. Never buy a stock simply because everyone else is talking about it. Ask yourself, why is this company valuable? How does it make money? If you can't answer those questions, don't invest. Simple as that. Don't jump on any stock because people are talking about it. And then, the eighth mistake is putting all your money in one company. Never put all your investment in one bucket. Imagine investing your entire portfolio into one company. Then unexpected bad news hits. Your investment drops by even 40%. Now your entire financial future depends on one business. That is a necessary risk. Instead, spread your investment across different industries, across different sectors. That eliminates losses. Of course, not completely, but then it reduces losses by a great deal. Okay? And then, the seventh mistake is panic selling during market crashes. This is where many fortunes are lost. Market falls, fear spreads, news hits headlines predicting doom, people rush to sell. But history shows something very interesting. Every major market decline has eventually been followed by recovery. The investors who stayed invested often came out much stronger compared to those who chickened out. Temporal declines are normal. Permanent losses usually happen when people panic. So stay calm, relax. And then mistake number 6 is ignoring company fundamentals. Some investors buy shares because my friend recommended it. I saw it on social media. Everyone says it's going up. That is gambling. That is not investing. Before buying any stock, ask yourself these questions. Is revenue of this particular company growing? Are profits increasing? Is debt manageable? Does the company have competitive advantage? Strong businesses usually create long-term shareholder value. Weak businesses rarely do. So don't jump to buy any stock because people are talking about it. Do your research. And then, mistake number 5 is trying to get rich quickly. Many beginners expect to double their money in months. When that doesn't happen, they become impatient. Then they start taking unnecessary risks. Successful investing isn't exciting. It is often very boring. Buying quality companies, holding them, reinvesting dividends, repeating the process. That is how wealth is built. Wealth is never built quickly. And if a person promises you quick building of wealth, probably that is a scam or setup for you to fail. Mistake number 4 ignoring dividends. Many investors focus only on share prices. They forget dividends. Yet dividends can account for a significant portion of long-term investing returns. Imagine receiving cash every year, then using the cash to buy more and more shares. Those extra shares you generate over time are going to give you more dividends and even increase your portfolio value. So reinvest your dividends. And then mistake number 3 is investing with emotions. Fear, greed, excitement, regret. All these are a mix of emotions, whether negative or positive. These emotions destroy more portfolios than recessions could ever do. Successful investors don't react emotionally. They follow a plan. You devise a plan, stick to it, follow, and see how you refine it. They do buy after researching, not following headlines. Successful investors do not panic, do not hype, they focus and don't react based on emotions. Because emotions make expensive mistakes, discipline makes wealthy investors. Be disciplined for you to be wealthy. Mistake number 2, never continuing to learn. The stock market rewards knowledge. Keep reading, study annual reports, understand industries, understand sectors, learn how businesses operate, gain more knowledge as much as you can. That way, you'll make fewer mistakes over time. Investing is one of the few areas where learning directly improves return. So keep learning for you to be able to set yourself up for success in investing in stocks. And then the very first mistake is not starting early. This is the biggest mistakes of all. Waiting. Every year you delay investing. You lose another year of compound growth. Imagine two friends. One started investing at the age of 25. Another waits until 35. Even if they invest in the same amount of money each and every month in the same company, the person who started earlier often ends up with dramatically more wealth compared to the one who started late. Time is the greatest asset an investor has. Once it's gone, you can never get it back, even if you try to chase that particular time. So, as we conclude this video, here's the good news. Every one of these mistakes is avoidable. You don't need a finance degree. You don't need millions of shillings. You don't need insider information. You simply need to be patient, disciplined, and committed to making better financial decisions than the average investor. If this video is helpful, please remember to subscribe to this channel and also hit the like button. Cheers, guys. Look forward to catching up with you in the next amazing video. Stay tuned, you all.